When the PE ratio is high and also there is a growth in that stock, you can consider this stock is premium. There are a bit of consolidation phases when you see. In recent years, the PE ratio is consolidating but the price is going high. If the fundamentals of this stock is good and it is trading below the sector PE, then it is a gem. There is no such benchmark PE to observe, but there is one ratio which can help you in this decision. There was a saying, if a company's PE is more than 30, that is overvalued, avoid it. If the company's PE is lesser than 30, that is undervalued, you can consider to invest in that company. But this strategy doesn't hold good for a stock in every situation. I don't promise you that you would make profit because of the information shared in this video, but I will promise you won't incur losses. Hi, hello, welcome to the show. I am Abhishek Ramappa. When you consider stock market participation in India, there is a quantum leap when you consider Demat account opening data. Even the common man is entering the stock market with an intention to grow profit. But not many are in profits because maybe they have taken a wrong decision. They entered a stock in a wrong time. Maybe because of fear of missing out, they entered into the stock market. Soon after some volatility kicked in, they took back the investment so that to save the remaining principal. But this is not how you make profit in stock market. We are going to discuss a very important aspect which, properly understood and implemented, will help you take informed decision in stock market investment. I don't promise you that you would make profit because of the information shared in this video, but I will promise you won't incur losses because the topic we are discussing is very crucial. Even the most seasoned investors go to this ratio to understand if the stock is overvalued or undervalued. I have got 4 stocks. I want to eliminate others and choose the right gem. How to do that? The answer is PE ratio, price to earning ratio. Let's consider Apple for example. During the festive season, the rate of Apple per kg may go up to 200 rupees, 220, 250. The general price after festival, maybe the nominal price of an apple per kg is 100, 120, maybe in and around that rate. Why is it 250 during festive season? It is because demand and supply, it is overvalued in that time. Soon after the festive season ends, the prices come back to the normal. So when you are investing in a particular stock, you should enter in right time when it is in the undervalued zone. So how to distinguish? PE ratio comes to your help. First, let's understand what is PE ratio. Price to earning ratio. A stock is earning me 1 rupee. What is the cost I am ready to pay? What is the price I am paying or the market is paying for that 1 rupee earned by that stock? For an example, if you take any third-party application and open a stock, below that, maybe the fundamental section, it will show PE ratio. What is the PE ratio of that particular stock? For example, if that stock is trading at a PE of 25, it means the stock is earning me 1 rupee and the market is ready to pay the price 25 times, that is 25 rupees for that 1 rupee earned. This is the basic definition of PE ratio. How to calculate PE ratio? Market price of that stock divided by earnings per share. How do you calculate earnings per share? EPS formula is PAT divided by number of shares. When you go through company financials, maybe the quarterly results, you'll get readily available information regarding PE also. But this is the formula to calculate PE ratio. When you see PE, besides that, there is something called TTM in any third-party application or the website. What does TTM mean? It means trailing 12 months, which says the PE ratio that you are seeing is for the last 1 year data or the 1 year performance of that particular stock. So PE TTM is the last year's performance of that stock. There is something called forward PE. What is forward PE? Forward PE is calculated on basis of the estimations of that company. The company says this would be the earning per share in the next year. This would be the revenue growth in the next year. This number would be the profit growth of this stock in the upcoming 4 quarters. This is 1 year forward PE. It is purely an estimation. It is not based on fact. If you have enough trust on the company's management and you trust those forward PE estimation, and if you find that's good, the company is growing, you can take a decision of investing in that company in that particular time. So, forward PE is very important while taking futuristic decisions. Many of the investors and also the research analysts take into consideration the forward PE to take final decision of entering into the stock or to abstain from it. So now let's dive deeper into what PE does to the stock. What PE actually is, why PE is so important. When you consider a stock and the PE is so high, which means the market is very much optimistic about this company. The market is expecting a lot from this company. If the company is trading at a lower PE, the market is not so optimistic or not so positive about this company's growth prospectus in the near future. There was a saying, if a company's PE is more than 30, that is overvalued, avoid it. If the company's PE is lesser than 30, that is undervalued, you can consider to invest in that company. But this strategy doesn't hold good for a stock in every situation. So you have to consider fundamental analysis first, which means revenue growth happening, profit growth growing, and also debt to equity. There is a little bit of debt in the company, not so much to worry. And also the sales growth, it is growing quarter to quarter. If this is the case and the fundamental analysis is good, then if the fundamental analysis of the bunch of stocks you have selected for analysis is like identical, then you consider PE ratio and eliminate the overvalued one and consider the undervalued one to invest in. To further simplify this, consider an example of Mercedes-Benz versus an Alto, iPhone versus an Android or a basic level entry phone. Why are people willing to pay premium to these? Benz and iPhone, maybe BMW, Audi. Why is it so? Because of the experience and also the service what they are giving, the premiumness they carry. The market believes this price is worth. So, when the PE ratio is high and also there is a growth in that stock, you can consider this stock is premium. It is justified even if you pay premium because the stock is performing well. To evaluate the premiumness that we just discussed, you have to understand about peer PE and industry PE. What is industry PE and what is peer PE? Industry PE, for example, consider a software company, maybe Infosys. What are the peers for this company? Maybe Tata Consultancy Services, Wipro, these kind of companies. There are many companies working in that space. So, taking the average of all these companies' PE, industry PE is arrived, maybe 23. Let's consider 23 is the industry PE for software companies. Okay, 23. If a XYZ company is trading at a PE of 30, when the industry PE is 23, this particular stock is trading at 30, what do you understand? This company is overvalued when you compare with industry PE. The same applies if the industry PE is 23 and the stock is trading at 18 maybe, 18 or 15. If it is trading at 15, the stock is undervalued or the market is not expecting more from this stock in this situation. If the fundamentals of this stock is good and it is trading below the sector PE, then it is a gem which is undervalued. You can consider investing in this stock. If the fundamentals are not so great and the company is trading above the industry PE, that means you should try and avoid such an investment decision. So this is how sector PE comes to your protection. So what is peer PE? Peer PE means we discussed about many companies in that sector. If Infosys is trading at 18 PE and TCS is trading at 20 PE and maybe Wipro is trading at 15 PE, the industry PE remains the same 23 and you can chart it down where the companies belong, in the overvalued zone or the undervalued zone. Let's see that practically. Open Ticker Tape website in your browser and type Infosys. When you scroll down, initially you will get to see key metrics. TTM PE ratio of Infosys is 29.95. That means trailing 12 months PE ratio of Infosys. What is the sector PE? 37.57. Considering sector PE of 37.57, Infosys falls in the undervalued zone. So click on peers. Look at this. Infosys PE ratio 30.77, Tata Consultancy TCS 34.93, HCL 33.37, Wipro is 29.17. So looking at the PE ratio of the Infosys or the buddy companies in software technology space, Infosys and other companies, you can compare with industry PE and where these companies belong, overvalued zone or undervalued zone. Now let's practically understand how to check overall PE or the historical PE of any particular stock, and also try to chart down what is the PE growth and also the price growth. Open Screener, type Infosys and scroll down. You get to see something like this, a chart for 1 month, 6 month, 1 year, 3 year, like this. Click on max. So you get to see the maximum PE of that company. So click on PE right over the top right. So look at this. It was trading at 29.4 PE during 2007, and then there was a consolidation till 2009. Again there was a rise till 2011, and again there is a consolidation in PE ratio. That means the price paid by the market, it was consolidating again and again, a kind of cyclical thing till 2013. After that there is a kind of stagnation for some time, and again after 2020 there is a rise in PE ratio till 2022. Again there is a consolidation in PE ratio when you see for Infosys. Now click on price. When you see PE ratio, there is very much volatility to see. So the market sentiment about Infosys was changing again and again. But when you see the price growth, it has shown a steady growth. There is no fall like 30%, 50% in Infosys price performance. There are a bit of consolidation phases when you see, but the stock is giving good returns. So when you consider Infosys PE ratio and price growth, in the initial days, there was a difference in expectation of the market, but the price was steadily growing. In recent years, the PE ratio is consolidating, but the price is going high, which means Infosys is outperforming the market sentiment. The stock price need not necessarily go down when the PE ratio goes down, and it need not go up when the PE ratio goes up. It's not like that. But you should consider, if the PE ratio is growing and also the price of that stock is growing, you can pay the premium because it is a good performer. If the PE is growing and the market price is not growing, then you have to reconsider your investment decision. This is how you can observe and analyze the price rise and also the PE ratio of any particular stock to take investment decision. Now, if you ask me, tell me one particular number to decide on an investment decision about any particular stock. When you say there is a benchmark of PE, this is the PE, above this is overvalued, below this is undervalued. There is no such benchmark PE to observe, but there is one ratio which can help you in this decision. That is called PEG ratio, price to earnings growth ratio, which means price divided by earnings per share divided by earnings per share growth rate. So simply to say, PE ratio divided by earnings to growth ratio. To further simplify this, we'll take a real case example. Case 1, which is PE ratio of 15 and the earnings to growth ratio is 10%, which means 15 divided by 10, which gives a value of 1.5. The 1.5 says market is expecting 50% more returns from this company. In the same case, the company's PE is 15 and the earnings to growth ratio is 20, which means 15 divided by 20, which gives 0.75. That is, the market is expecting a 25% lower returns from this particular stock, or the market is having a negative kind of sentiment about this stock's performance. So if the PEG ratio, PEG ratio is hovering around 1, that is the nominal rate to buy or enter into a stock. If it is like 1.5 and the fundamentals are not so great, beware. And the fundamentals are good, it is less than 1, maybe say 0.8, 0.9, it's a right time to consider. So this is how you can try and analyze stocks which you have shortlisted to eliminate the overvalued and to pick the undervalued right stock in consideration with fundamental analysis. And also the stock name which we have discussed in the video is just for educational purposes and it's not a stock recommendation. Do your due diligence and take a wise decision in entering such stock investment. I hope the information discussed in this video will help you to distinguish between overvalued and undervalued stock. If you have found any value from this video, hit that like button and also share your opinion in the comment section. And also do subscribe to our YouTube channel and also click that bell icon to get notified when a new video is released. Thank you and all the very best.